Hey guys, so we're back at it for video number 2 of the 6-part video series on the Basis trade engine. So last video we touched on what is a Basis trade, the mechanism of funding, how that works. So hopefully by now you're up to speed with the Basis trade engine and how it executes based on that funding mechanic and what incentivizes the market to participate in trading based on that funding mechanism. So this video will be a little bit more in depth on the products that the Basis trade engine uses and the trade types that we can execute using those products. So that's what this video will be about. We'll talk about how to access the Basis trade engine if you already have an NFT or if you don't have an NFT yet. So the Basis trade engine relies on that NFT, that Basis Markets NFT, for access via the Basis Markets website. So I'll walk you through that and show you how you can log in and activate your trade engine access. Let's start off with how can I get an NFT, a Basis Markets NFT, and gain access to the Basis Markets trade engine, because that's where it all starts. Let's have a look at that. We are on SolSea, which is an NFT marketplace for NFTs on Solana. So the first thing to look for is this blue tick here next to the Basis Markets collection. So if you're searching, okay, so what we can do is go explore and then go to collections, and that will bring up the collections page. So then we need to type in Basis. There we go. So Basis without a space. So it's actually basis.markets. And we click on Basis Markets collection. There you will see that blue tick, a verified collection. So that's the problem with the NFT space. You can have a lot of fakes and a lot of dodgy listings, but here you can see the verified collection. So any with a blue tick is verified and is a legitimate Basis Markets NFT. So from there, you need to make the purchase, connect your wallet, and then you'll end up with the NFT in your wallet. So that's step 1. Step 1 is acquiring an NFT, and from there, you can get yourself sorted on the Basis Markets webpage. Then you need to go to the basis.markets webpage. And from there, you need to have your wallet that now holds those NFTs connected. So my wallet holds the NFT. It is now connected to the page. I do that by hitting that login button at basis.markets. So log in. And when you first go to set up your account, you'll be prompted to input your Discord handle and do a few little bits and pieces to make sure that your profile on the Basis Markets webpage gets set up. So it links back to your Discord profile, and your NFT allows that process to happen. So the Basis Markets webpage recognizes that your wallet, your Phantom wallet or your Solana wallet has an NFT, and then it goes on to prompt you to put in those Discord details. So from there, we now have full access to the Basis trade engine, which you can see up here. So new tabs will open compared to what we originally had. We now have, instead of just team, roadmap, and other basics, we now have the funding opportunities, the coin analysis, funding data, borrow data, as well as careers and staking. So that's how you get set up in the first instance to get access to the Basis trade engine. So now we can go into the actual trade engine itself. So from the funding opportunity page, you will have access to all of those opportunities that the Basis trade engine is scanning for every second, every moment of time. So parameters on the left, you can use filters to adjust based on the capital, based on exchanges, based on the interval, volume, leverage long, leverage short, and the confidence levels. But let's focus on the trade types and the products that the Basis trade engine uses to execute these trades, or to at least scan for these trades. So down the bottom, we've got products being spot, perpetuals, and futures products. So let's go through those and understand what they are. So we'll begin with futures contracts. So Wikipedia, awesome source. Wouldn't be my go-to, but for the simple explanation, in finance, a futures contract, sometimes called futures, is a standardized legal agreement to buy or sell something at a predetermined price at a specified time in the future between parties not known to each other. The asset transaction is usually a commodity or financial instrument. So simply, it's a contract, a derivative of price, a derivative of the spot contract, the spot product, and it's traded on exchanges just like a spot product would be, except these contracts expire and they roll over. So what we're looking at here is the Bitcoin June 2022 futures. So this contract expires at the end of June. You can see where is the expiration time? The 24th of the 6th, 2022. And you can see at the moment that it's actually trading at a premium to the underlying. So the underlying being the spot price is trading at 38,091 or 38,121 now. And the futures contract for June is trading in what's called contango. So where the futures price is higher than the current spot price. And that's a natural phenomena of markets. So that futures product is trading $400 at a $400 premium to the spot price right now. Okay, so the next one we have is perpetual futures contracts. Okay, so our friends at CoinDesk are letting us know, well, they've written an article here on what is a perpetual swap contract, what is a perpetual futures contract. A perpetual swap contract is a type of derivative trading product that has become increasingly popular among crypto traders, and daily trading volumes recently have been over 180 billion US dollars. So they were launched in 2016. They offer traders a chance to take on large positions in cryptocurrency with little money down, so meaning leverage. And this opportunity to win big on small movements tends to entice a lot of people, a lot of volume. With such big rewards, obviously there comes a big risk. So perpetual futures, like we spoke about in the first video, use the funding mechanism to incentivize both sides of the trade. And that's where we make our basis or our yield on our position, by being delta neutral and accumulating that the premium or the cream on top of those positions. So a perpetual swap is somewhat similar to a futures contract in that it allows traders to speculate on the future price movement of a cryptocurrency. The core difference is that, unlike a typical futures contract, so unlike this one that we're looking at here, the perpetual swap does not have an expiration date, so it continually rolls over. In essence, this eliminates the need to constantly re-establish a long or a short position. So with a traditional futures contract, at the end of the month or whenever the contract rolls over, you'd have to re-establish on the next contract. So you've got BTC for June here. So we look at futures contracts, and there's one that expires in March as well. So this one here, so say we were long or short this contract, we'd have to close that out before expiry and then move our money into the new contract, which would be June. So you're constantly having to do that on expiration. But the perpetual contracts you don't need to do that. So due to the absence of expiration dates in perpetual swaps, exchanges implement a price anchoring system called the funding rate mechanism. So that's the core differentiation between a traditional futures contract and a perpetual swap or the perpetual futures contract. So as we spoke about in the first video, this mechanism balances the short and long positions of perpetual swaps by either incentivizing or disincentivizing trades. Think of it as a rebate or fee that helps balance out the demand for short and long side of perpetual contracts. So that's exactly what we spoke about in the first video. So that's the core differentiation between futures contracts and perpetual futures contracts. The funding mechanism allows the contract to continually roll over without having the need to swap into a new contract like traditionally you would have to. Now it goes on to say about funding rates, etc., but we don't really need to know that. We just need to know the difference between these products. And the last product, just touching back on the futures versus the perpetual swaps. So perpetual swaps are more highly liquid, so they're easier to get in and out. And traditional futures contracts are a little bit less liquid, so it's harder to get in and out of those. And that's the differentiation that you need to be aware of when you're trading based on suggestions of the Basis trade engine. So be aware that it's harder to get into a traditional futures market or futures contract position, and it's easier to get into a perpetual swap or perpetual futures contract position, just based on the liquidity and how many people trade those contracts. So spot, is not a derivative of price. It is the actual product itself. So Bitcoin spot is Bitcoin, and that can be transferred across the blockchain, whereas futures contracts or perpetual swaps contracts cannot be done in that way. They stay on the exchange and they're facilitated by the exchange. But spot is the physical, not the physical, but the, if you want to call it the tangible product itself. So it's the Bitcoin, it's Ethereum that can be transacted across the blockchain. That's what spot is. That's the key differentiation. So we'll also go on to talk about how you can use margin trading on the spot pairs to further increase your gains on the basis trade engine. So that's something that people don't really know. So when you're using the reverse basis trades, where you're going short the spot and long the perp, you can get short the spot product and borrow US dollars and then go and long the perpetual contract, and that's the reverse basis. So that now brings us to the trade types that can be executed on the basis trade engine. So you'll see here in the bottom left corner, you've got trade types. The first one being basis. So what is a basis trade? So basis trade is in the context of futures trading. So that in cryptocurrency, that can mean the traditional futures products that we just spoke about, or the perpetual swaps, perpetual futures contract. So in the context of futures trading, the term basis trading refers generally to those trading strategies built around the difference. So the difference between the spot price and the futures price for that same asset. So where we have a disconnection between the futures contract or the perpetual futures contract to that of the spot price, we can take advantage of that by capturing the premium that exists on either side. So if the perp is trading, the perpetual contract is trading higher than the spot price, we can take advantage of that disconnection via the funding rate. So that positive funding rate when the price is higher than the spot price. And by the same way, we can take advantage on the other side when the perp is trading below the spot price and take advantage of that funding rate that exists. So if we look at, say, BTC futures, so Bitcoin perp right now, and you can see it's trading mostly in line. But let's look at something like what's going to be a little bit different. So maybe YFI. Okay, so you can see the blue line. So the blue line is the spot price and the candles are the perpetual contract for YFI. So we can see that there's a negative funding rate that exists right now on YFI, and we can take advantage of that difference that exists between the blue line and the current price of the spot price via a basis trade. Well, in that case, it will be a reverse basis trade because there's a negative funding rate, and a normal traditional basis trade would be a positive funding rate. So if the blue line was trading below the candles, that would be a positive funding rate and a positive basis trade. Right now, what you're looking at is a negative funding rate and a reverse basis trade. Okay, so that's what a basis trade is, where you're taking advantage of that difference that exists between the two products. So I think we touched on the basis and we touched on the reverse basis. Now the long and the short. So let's see if we can find a long and short trade right now and just show you what that exactly means. Okay, so here the long and the short is where you've got totally disconnected funding rates on a product on two different exchanges. Okay, so you can see here on the long side, you're being paid an APR to get long. Negative 115% on Waves, on FTX, on Delta, on OKEx. And also on the short side, you're also getting paid to be short. So you're getting paid both ways. So you can be long on one exchange and short on the other and get paid funding on both sides. It's quite insane. So when there's that disconnection that exists, you can be short on one exchange, long on the other, makes you delta neutral. And at the same time, you're still collecting the funding that exists. So you're being delta neutral, you've got two positions open, one long on an exchange and one short on an exchange, but they're both paying you a funding rate, which is quite insane. So the exchanges are just totally disconnected from each other, and there's a big inefficiency there that you can take advantage of. So that's the long and the short. So I think that's covered this video. So the trade types and the products, you've got the basis, the reverse basis, the long and the short, and the products used. So spot, perpetual, and futures. That'll do for this video. I hope this has been insightful. In the next video, we'll go through the BTE, scan for some opportunities, and look at the things to look out for. So you've got APR stability, borrows, trade confidence, volume, and open interest. So we'll gradually move along to the point where we're comfortable at taking a basis trade that the BTE presents to us.